Let's talk about the reaction in bond markets first. So really what seemed to kind of spur the big risk off was the data that we got out of the US in terms of the US manufacturing PMI hitting its lowest in a decade. And that new orders gauge really caught attention as well, a contraction for the first time since August 2009. It begs the question whether that first quarter GDP number was kind of down to companies front-loading their orders ahead of concerns around an escalation in the trade war. So my question to you, Paul, is how bullish is this backdrop for bonds at the moment?
Well, I suppose you've got to conclude that it's pretty bullish. We're certainly looking at the central banks not changing monetary policy in the near term. So in other words, keeping it very loose, which is means that they're maintaining a very low interest rate. And therefore, bond markets are probably the safe haven market of choice. If you believe the global economy is slowing down, which I guess we do, it looks all the evidence so far is that the economies are not responding to this pausing in central bank attitude. They need more than that to actually turn around. And if we're going to see a continuation of slower economic growth, then bond markets probably should continue to grind higher. It's not a bad place to be in this environment.
What would be the catalyst, Chris, for you to actually add back to equities? Because you're actually underweight equities at the moment, and we are seeing the S&P 500 poised for its first losing month of 2019. The context is, though, it's still up more than 12% this year. Yeah,
absolutely. I mean, just to give a bit of context around that, I mean, we've had concerns about rising risks for about 15 months now, really, through the course of last year. And by September last year, we were at our most cautious on equities. At the beginning of this year, we moved closer to neutral. And in March, as you rightly say, we moved back underweight again, really because we were questioning the extent of the rally which we'd had. And I think the problem we have right now, consistently this year, is that one of our blocks of indicators is growth. And we've just not seen confirmation from our growth indicators of the rally which has taken place in equities. We're still looking for the green shoots of a synchronized global recovery outside of the US. The US is still doing pretty well, but outside of the US, we're in a pronounced growth slowdown, and that's where we've yet to see the daylight. And I think that did start to open up a potential gap between reality and perception in equity markets, and that was our concern in March. I think that reality is beginning to dawn now, and so this correction so far actually we see is quite rational and probably quite sensible, and not yet of great concern. But we do have to keep a big eye on bond markets because they're an indicator of future growth as well, and they are painting a grimmer picture of growth than equity markets are at the moment.
Yeah, so in terms of a catalyst for you to add back then, what data points precisely or what themes do you need to see in equity or bond markets? Do you need to see the 10-year Treasury yield at a certain level? Do you need to see pricing change around a Fed rate cut for you to think, now we add back to equities?
Yeah, well, for us, I mean, it really is keeping an eye on these growth indicators, and we have a panoply of them, sort of leading indicators. And as I said, it's less about the US and more about outside of the US. So, for instance, some pickup in the purchasing manager surveys in Europe would be a good indicator. It's also been one of the absentees from the party in the last few months, which has concerned us. Looking at the US, we've had a little bit of, so we have seen a fade in growth in the US. Now, we've still got a good margin of safety between the run rate of growth in the US and any kind of recession, but we have been slightly concerned. But as long as Europe and the EM aren't driving global growth, there is the potential for further fade in US growth to the point where people could start to question a recession in the US. I don't think we're there yet, and that would be quite a problem. But I think at the moment we're not, it's not too bad. There's still time for the indicators to turn around in Europe.